Greetings, everybody. Welcome to Liberty Call. Today is Monday, October 2nd, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. It is 70 degrees, sunny, and not a cloud in the sky. It is wonderful. Me and my boy Jake are going to go back out and play some more ball as soon as we finish up here. And, it looks like the market's, not too terrible, but, still kind of angry. And see a lot of red across the global markets here for the first day of the quarter. It is the fourth quarter of 2023. You'll be glad when we get this. It's been a bunch of crappy years, unfortunately. So anyways, all right. Well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me one favor and one favor only, hit that like button, hit that subscribe button, hit that follow button, hit all those buttons. Hit the notification bell so you know when I go live, because you don't want to miss out on all this genius stuff I share on a daily basis. So all right, let's go ahead and get to the numbers for today. Dow Jones finished the day down 0.22%, 74 points. It was like 150 points at its worst, I think. Closed at 33,433. The SP 500 was flat, down 0.01, closed at 4287. NASDAQ, one of the bright spots, was up 0.67%, closed at 13,307. The VIX the VIX was up 0.29% today. Closed at 1757. Canada down 1.86. Brazil down 1.3. And Mexico was up about 0.75%. In Western Europe, Germany down 0.91. The UK down 1.28%. France down 0.95. The Netherlands down 0.63%. Spain down 1.16%. Italy down 1.39%. Switzerland down 0.91%. And Portugal down 0.42%. Russian exchanges, both in the red today. The MOEX down 0.03, so fairly flat. RTSI down 1.53%. And the Asian markets, starting out with the Nikkei in Japan, was down 0.21%. Australia down 0.22%. New Zealand down 0.45%. Looks like the Chinese markets are still closed. Taiwan weighted was open today, and it was up 1.24%. And about 203 points. So, all right. So that's everything for the markets for today. So, like I said, not terrible, but looking at the bigger trend that we talked about at the end of last week, doesn't look like things are looking real good. If the Fed was wanting to continue to raise rates or hold them where they're at and hope that the market stayed fairly flat, or I'm sure they hope that it continues to go up, but I think, the recession bells and signals they've been, flashing all year, I think they're probably going to get their wish. Things are just slowing down right now. So, all right, let's go ahead and get to the weekly update and see what's going on there. Rising bond yields and government shutdown fears left stocks in mostly negative territory for the week. The Dow lost 1.34%. The SP 500 slipped 0.74%. NASDAQ was flat, up 0.06%, and overseas stocks fell 1.95%. Stocks followed the bond market. The bond market drove stock prices for much of last week as investors fretted about rising bond yields. After beginning the week with small gains, stocks resumed their September decline amid weak housing data and a decline in consumer confidence. However, it was the jump in bond yields which sent the 10-year Treasury yield near a 15-year high that may have undermined investor sentiment. After a failed attempt at a rebound midweek, stocks staged a Thursday rally on a pause in bond yield increases, a rally that extended into Friday morning on encouraging core personal consumption expenditures price index report. But the rally faded as traders fixated on a potential government shutdown, which was averted for 45 days. We'll get to that in a few minutes. All right. Mixed economic signals. Amid recent signs of labor market cooling, a hopeful sign for ending rate hikes, last Thursday's initial jobless claims report showed only a slight increase of 204,000. That was the second lowest reading since January and below economists' expectations of 215,000. Continuing claims declined by 12,000. The same morning, the final estimate of second quarter GDP was released, indicating a 2.1% annualized growth rate, unchanged from the previous estimate. However, beneath the headline number, consumer spending was cut to a 0.8% rise from its earlier estimate of 1.7%, so basically a 50% reduction. A worrisome revision since consumer spending is the engine of the U.S. economy. Weekly economic data this week. Monday, we have the ISM, the Institute for Supply Management Manufacturing Index. Tuesday, job openings and turnover survey, the JOLTS report. Wednesday, we have the ADP Employment Report and Institute for Supply Management Services Index. Thursday's jobless claims, and Friday is the employment situation. Just one major company reporting earnings this week. Thursday is Constellation Brands. All right, so that is the weekly update. Do you feel extra knowledgey and smart up here? I know I do. All right, let's get to the market recap for today. S&P 500 slips in volatile trade as surging yields bite. All right, so we're just going to breeze through this pretty quick. I didn't do a summary today. All right, the S&P 500 fell after swinging between gains and losses Monday amid rising Treasury yields as the U.S. averted a government shutdown after agreeing to a last-ditch funding measure to keep the government funded. Treasury yields were pushed higher by growing expectations for another Federal Reserve interest rate hike after the U.S. government averted a shutdown. The two-year Treasury yield rose 5.2 points to 5.098, while the 10-year Treasury yield rose 9.3 basis points to 4.669%. Congress passed a short-term funding measure to keep the government funded through November 17th, avoiding a shutdown that may have expected to dent near-term economic growth. About 30% of traders expect the Fed to lift rates next month, up from about 18% last week, according to Investing.com's Fed Rate Monitor tool. Big tech loses some steam as surging Treasury yields bite. Big tech cut some gains, pressured by rising Treasury yields. The enemy of growth stocks, though remained supported by a rise in Alphabet and Meta platforms. Nvidia up 2%. Also helped support the broader tech sector after Goldman Sachs added the chipmaker to its conviction buy list, which typically includes the stock that the bank believes is likely to outperform. Nvidia is likely to maintain its status as, quote, the accelerated computer industry standard for the foreseeable future, given its competitive moat and urgency with which consumers are developing and deploying increasingly complex AI models, end quote, Goldman Sachs said in a note. Tesla was flat after reporting Monday that it produced 430,488 vehicles in the third quarter, down from 479,700 in the previous quarter, owing to a planned shutdown for factory upgrades. The electric vehicle maker, however, kept its full-year production guidance of about 1.8 million unchanged. Tesla will require a, quote, strong fourth quarter to hit this number, Wedbush said, adding it sees, quote, better days ahead for Tesla for Q4 and 2024. Tesla set to release its Q3 results after the market close on the October 18th. Bitcoin rose more than 3%, sparking a surge in crypto-related stocks as Riot Platforms, Marathon Digital Holdings, and MicroStrategy Incorporated rallied. Coinbase Global gave up some gains to trade less than 1% after the acquiring a payment license in Singapore, paving the way for the crypto exchange to offer digital payment services to individuals and investors in the country. Energy fell more than 2%, paced by a decline in EQT Corporation and Marathon and APA Corporation, as oil prices were dragged lower by concerns about rising supply and the high dollar. Still, oil prices remained above the $90 a barrel, with some forecasting a boost in demand from China's annual Golden Week holiday. Quote, oil demand looks strong with China starting its Golden Week holidays, ANZ Research said in a recent note, referring to the 8-day annual event in China, which got underway last Friday and typically sparks demand for travel and spending. All right, so that's some good stuff right there. Alrighty, so let's take a couple seconds here and... All right, so like I said, the looks like everything is doing okay. You know, not too bad, but at the same time, certainly not as good as we would like. Just a second here. All right, and where are we? Let's get down. Next up on our docket is, let's see here. Oops. Doing things in real time here. So bear with me for a second. There go. And okay. All right. Next up on our docket is an article here for the Shutdown Averted for 45 days. This is written by Philip Mary, senior U.S. strategist at Rabobank. So let's see what he had to say here. All right. In a surprising move, House Speaker Kevin McCarthy defied the hardliners in the Republican Party by proposing a stopgap measure to extend government funding through November 17th. So basically, we got about a 6-week stay of execution. The measure passed with bipartisan support, which includes $1.6 trillion annual rate for the fiscal year 2023. That's probably 24, and $16 billion in disaster relief. But it excludes additional aid for Ukraine and border security provisions. Yeah, because we don't need to do anything about the border. The unexpected decision by McCarthy, who may face a challenge to his speakership, averted the government shutdown on October 1st. I know, what's the guy? Matt Gaetz out of Florida is really pushing to get McCarthy tossed out of the speakership. I personally don't care. I hate Republicans and Democrats equally. They're all trash. All right. Last week, McCarthy's attempt to include hardliners failed, including leading to the rejection of a continuing resolution at a lower annual rate. McCarthy, recognizing the inevitability of a speakership challenge, decided to switch to a bipartisan solution to avoid a government shutdown. The House voted 335 to 91, with nearly half of Republicans voting against it, and the Senate followed with an 89 to 9 vote. President Biden signed the continuing resolution into law, securing government funding until November 17th. However, considerable challenges lie ahead. The government must adopt 8 appropriations bills for fiscal year 24 before reconciliation with the Senate versions. Disagreements persist over the total federal spending for fiscal year 24, border security, and additional funding for Ukraine. Ukraine can fall into the ocean for all I care. McCarthy's speakership may face a challenge from the Freedom Caucus later this week. While the government shutdown has been averted until the 17th of November, unresolved issues and political turmoil on Capitol Hill persist. The 7-week extension provides a limited window for Congress to approve appropriations bills and address contentious issues, with the specter of a potential shutdown looming if a new stopgap measure is not approved. So, I mean, it seems like they've, again have, kicked the can for, a few weeks down the road. But, in the grand scheme of things, is that really going to matter? I personally don't think so. But, we shall see what happens long term. All right. One last article comes from our friends over at First Trust, Mr. Brian Westbury, their chief economist. This one is Tax Policy Outlook. Let's see what he had to say. As the fiscal year ended, a last-minute deal averted a government shutdown, extending it for another 45 days. Preliminary estimates suggest that the deficit for the past fiscal year will surpass $1.7 trillion, constituting 6.5% of GDP. Despite a relatively low unemployment rate of 3.6%, this deficit signals significant issues in U.S. fiscal policy. Most notably, the deficit was artificially restrained by the Supreme Court's rejection of much of President Biden's plan to forgive student debt. Without this, the deficit would have neared 8% of GDP. This substantial deficit sets the stage for a fiscal reckoning in the coming years, compelling the U.S. to either curtail future spending or seek additional revenue. The geopolitical context adds complexity, with potential heightened military spending to assert influence in the Pacific. That's never going to happen. Let's see here. While advocating for spending cuts, particularly in entitlements, is favored, political resistance to such measures complicates the path forward. The establishment leans towards tax hikes, likely becoming a reality by 2026. This projection aligns with the expiration of significant parts of the 2017 tax cuts enacted under President Trump at the close of 2025. This subsequent year, the influenced by the 2024 federal election outcomes, will likely see negotiations about extending these tax cuts, if the Republic is still around. Anticipating a 35% chance of a Republican sweep in 2024, the continuation of Trump-era tax cuts is plausible. However, without accompanying spending cuts or entitlement reforms, sustaining these cuts beyond 26 becomes challenging. A 20% chance of a Democratic sweep could result in substantial across-the-board tax hikes, That's when the country splits apart at that point, including on income, gas, and potentially a carbon tax. I'm never paying that. A mixed government scenario with a 45% chance of a 2025-26 might lead to extending most Trump tax cuts except for the upper income levels, echoing compromises seen in the previous tax cut extensions. In essence, the U.S. faces an unsustainable trajectory, and without spending cuts, tax hikes appear inevitable in the near future. I personally hope that the federal government collapses, and then we can deport all federal workers and politicians to California. We put a big fence along the West Coast, along the Nevada border, Idaho, and we keep all those leftists out there. If they decide to come, across the fence, we shoot them. Problem solved. And then the rest of us here in the other 47 states, we live happily ever after. I think it's a great plan. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.